Wouldn't it have been great if a world famous, renowned investors had shared like a magic formula or his or her favorite special recipe of finding good stocks, fundamentally good stocks, investing, strategy, etc., and made it public? I came upon something very similar in this book, which I'm going to introduce, and the magic formula that Mr. Joel, the author of this book, introduced to us. If you're someone who is looking to identify fundamentally strong stocks on the Tadawul Saudi Stock Exchange, then this is a must video for you. This video will also help you to learn few fundamental metrics of evaluating a business and its efficiency. The little book that still beats the market. It's written by a famous value investor, Mr. Joel Greenbalt. He was the head fund manager for MagicFormula, also famously known for giving a consistent 50% annualized return between 1985 to 1994. It was not an outlier. It was not just 1 year. It was consecutively for 9 years between 1985 and 94. Has written multiple books. One of the famous ones is the little book that beats the market, which I read last week. It's a very short 150-page book, written in a very interesting manner. He's also like a student of Mr. Benjamin Graham. Like when I say a student, like given a value investor looks for fundamentally strong stocks. So according to him, investing is a very simple but a long-term game, right? Which has to be played with a lot of patience. And he is someone who has believed in companies with strong fundamentals, good management, and unique advantages can generate returns in the long run, right? So in this book, he introduced this Mr. Market, right, which is the whole stock market system platform, right, where people buy, sell, trade, right? So according to him, Mr. Market is at times very inefficient in evaluating the fundamentals and the pricing of an individual company for business. What does this mean? If I look into a particular fundamentally strong stock over a 52-week period, I will see big swings in the stock price of the company. And there could be multiple reasons, right? So let me take the example of Nadi Medical. So Nadi Medical, again, a very fundamental company, has medical store chains across the kingdom. If I look at the 1 day, it has been quite stable across 133 to 133.4. If I looked at 5 days, still 132.4 to 133.6. So quite stable, right? But as I go to that year to date or 1 year, I'll see that it starts from that 180. It went down to 120. Then middle of April, it came to 150. And now it is trading at 133. So the same company, same fundamentally strong company, has been evaluated across the 52 at multiple levels. So at times, the investors felt like 180 is a good number. Then they felt like 120 is the better number, is the right price for this company. And then they have done it, 150. Then this goes on, even for fundamentally strong companies as well. Not just for small caps, but even for large cap companies. So he is trying to explain why does this happen, right? And so in one of this explanation is this, there could be multiple reasons for this, right? One of the reasons could be, so it could be that people go nuts. It's hard to predict future earnings, which is true, right? The valuation or the price of a stock is based on the future. What is the potential future earnings of this company, right, over a long period of time? And different people can try to estimate this with different assumptions and different methodologies, leading to different, evaluations or even different stock prices. Maybe sometimes people are depressed and therefore they don't want to pay a lot for this. Sometimes they are super excited about the overall economy or about themselves and they are willing to pay a lot, right? So sometimes they justify it based on their emotions. Sometimes they justify based on XYZ factors. Someone got elected as president, so they felt happy. They're justifying that the high prices. So there could be X number of reasons, right, for such wild swings across very short periods of time. It's very difficult to exactly pinpoint to why this is the case. So for him, Mr. Market is inefficient, and this is like buying opportunities for fundamentally strong companies, according to Mr. Joel. Why this book got famous is he introduced a formula, or what he called as the magic formula, which is based on just two metrics, which I'm going to cover now. And he proved that by backtesting it on the historical 40 years of US equity. And then he also himself followed this magic formula to give this consistent annualized return. This book became famous for this magic formula, and that's what I wanted to cover. And wanted to implement this in our Tadawul stock exchange. And there are only two metrics that you need fundamentally to validate this. It's not just randomly looking at two numbers, but also having a solid management that's running the company. That's also a plus point. So also look at the fundamentals of that management, the experience of the folks, the experience of the company, that moat that they have, right? Along with that, these two metrics is what he claims to be like the magic formula. So number one on that was the return on capital, also known as return on invested capital, ROC, ROIC, which is earnings before interest and taxes divided by the invested capital, which is the working capital and the fixed assets, right? Now, yeah, why earnings before interest and taxes? Because then it's like a level playing field for all the companies, because some companies might be going for debt to get more earnings. Some companies might be going into, have to pay higher taxes, right? So to negate all these effects, he's going for the operating expenses, which is the EBIT, right? So a higher return on capital is better, and a company that is able to reinvest its capital and able to make more money is definitely much more favorable, right, than a company that is not able to get that much high return from its own invested capital. So this essentially is meaning that I reinvested my profit, let's say my money, and I'm get able to get a high return on that reinvested capital. And the second one for it was the earnings yield, which is again the operating expenses EBIT divided by the market capitalization. So this is more to do with the price that you are paying and the money that it is making on that price. Right. So again, the same thing, higher the better. And sometimes you can also use the P by E, or the price to earnings ratio, which goes in the opposite direction, right? So lower the P by E ratio, better is also the expected, or the relative value, right, for the company. So how he did is, like, first he ranked all the stocks listed on the exchange based on the ROC. Then he, the descending order, so higher to lowest. Then he ranked it based on the earnings yield, again highest to lowest. So you're getting like a ranking 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Then he summed them up, and the combined ranking is the final ranking. So he used to pick the top 5, 10 companies based on these two metrics. And then he used to combine these two rankings together to form the final ranking. So this was his magic formula. And he has also created a magicformula.com website where people who are investing in the NYSE stock exchange can, still use this tool, right? Which takes multiple filters and can apply this magic formula. Let us go to tradingview.com and then apply this on the Tadawul listed stock exchange. To identify, go to screener. So you see your screeners. I'll select Tadawul. So this has listed all the companies, that's there in, let me remove any filters. Let me remove all the filters. So there are 332 stocks, right? So let's add filters by filter. One thing he mentioned is, like, not to apply this to extremely small companies, because they can be more going for the growth. These numbers may not give you a good reflection of the company fundamentals. So to avoid that, so we have the P by E. Let me add the return on invested capital annualized. And then let me also add the market cap. Okay. Similarly, I'll also add those two over here. Return on invested capital annual. And the market cap, it's already there. Okay, cool. Let me get rid of some of these which are not needed. Sector. So get rid of this. Okay, perfect. So we have everything, right? So first is the return capital. I'll make it greater than 15 to start with. Okay, so that gives us 81 companies. I'll also make sure actually that the market cap is not extremely small, right? Because for really small companies, they're more focusing on the growth, trying to grow as fast as possible. It takes time. Sometimes the returns could be there, might uh, burn money to grow, right? So that could also lead to negative PE or negative ROIC, right? So I'll make sure that at least it's a it's still small, but it's not extremely small. So I'll put it to be 2 billion, and then we can play with that as well. And instead of earnings yield, I'm going for the price to earnings ratio. So this should be as small as possible. However, in the book, he has also mentioned that if the PE is like even less than 5, then something is wrong with the data, right? Something is wrong with the data. When the PE is 0, that means that the company is not making any money, profit at all, right? Earnings at all. So have some bare minimum. So I'm just keeping it to be 5. Then let's put it to be 20 and see how many companies are playing. So there are 11 companies which follow Joel's magic formula, at least a 15%. He did not give any specific threshold. Higher the better, right? So you can still rank them. If I just sorted by ROIC, then there are companies going with 40% ROIC, which is huge, right? So you can rank them as well rather than just filter. You can rank them. So higher the better for ROIC, lower the better for PE as well, right? So there are 11 companies. Jareer Marketing, Nadi Medical. Nadi is one of the examples I was giving earlier, right? So it's one of those very stable, large cap companies, right? Saudi Aramco, Saudi Arabian Oil, Aramco Base Oil. SABIC is coming up. That's very interesting. Saudi Advanced Industries, Saudi Cement, right? So all these have high ROIC. They are operating at a comparatively lower P by E ratio. So probably maybe, like look at this one. Nadi is at 19. Jareer is at 16. And the ROIC of 40%, which is too good. So you can play with, the market cap, you can play with these to shortlist the companies. But what do you do next? That's more interesting. Right? Is it like do I buy everything all at once? How much money should I put? Right? What should be the strategy of when should I sell? Right. So step number 1 and 2 is to basically, use your two metrics, ROIC or P by E ratio, to rank them, right? Then eliminate all the utilities and financial stocks, for example, insurance companies or electricity companies, because for these, the P by E is never alone a good metric, right? For insurance company, it plays a lot on the debt. Utility companies plays a lot on the debt. Step 4 is if it has extremely low P by E ratio, then something is wrong with the data. That's why I kept the minimum filter, right? Okay. Step number 5 is basically he's asking us to buy the first 5 to 7 stocks, right? So he's not asking us to just pick the top. Not, so he's not relying on just one stock. He's trying to build like a mutual fund, right? Like a portfolio of stocks, because some can play in this year, some can play in another year, etc. Right? So pick the first 5 to 7. If you have 1,000 riyals to invest this year, spend 200 to 300, 20 to 30% of that money to buy this. Right? Repeat this every quarter, every 2 to 3 months. You keep doing this so that by end of like 10, 11, 9, 10 months, you've spent the entire 1,000 riyals and you have like a portfolio of 20 to 30 stocks, right? For example, like let's say you were buying 5 stocks every quarter. So 4 quarters, that's like 20 stocks. So you have 20 stocks and you've spent like, the 200, 200, maybe 250, 250, 250. And you have spent like the whole 1,000 riyals to purchase that 5, then the next 5, then the next 5, then the next 5, spending the 200 riyals, right? So now you have a portfolio of 20 stocks where you spend the whole 1,000. Then what did he do? He said, hold it for 1 year and then sell that. You just sell it, hold it for 1 year, and then you sell it, and then repeat the same process the next year. So you have to do this multiple years. Just keep repeating it. The reason for selling it is most probably next time when you do it, there might be some new stock that has come through, right? Which is more recent, which has started having higher ROIC. Sometimes companies might have lost their moat, lost their product advantage, and therefore the return on the capital has started going down. Or sometimes there's so much of euphemism on a particular euphoria on one particular company that they have increased it so much. Especially in a bull market, this happens a lot, right? When all the people are investing in this is buying just one company, and therefore the price has soared by 1,000 times, for example, right? So then it's high risk to keep it still with you, so you sell it, and then you try to rerun the whole analysis again and keep repeating this. So there are a couple of factors here. One is you're not relying on one single company, you're always relying on a portfolio or a basket of companies. Number two is you're not putting everything in one go. You're breaking it down even across a year. Number three is you're repeating this over a long period of time. If you just do it for 1 year, it doesn't make sense. In the book, he recommended at least 5 years. A bare minimum was 3 to 5 years, but the more the better is what he said for the magic formula to actually work out, right? So, and then the fourth one is like uh, this is making sure that, especially in a bull market, when people are really crazy about certain brands and their price have gone very high, you're then removing that, right? So there's a churn, but again, it's not trading, because it's not on a daily basis you're buying and selling, right? It's more on the maybe on a yearly basis you're buying and holding. So this is investment, but you do this over a long period of time. And he emphasized this point very clearly. There are years when the return was even lower than the index. That can happen. It could happen for 1, 2, 3 years as well, but it's okay. What is really important is that you're following this, you're sticking to this plan. This is what he tried out, and he backtested this as well. So this is something, that I learned over this last week, which I wanted to share with you. Hope you like this video. My aspiration is to uh, do similar ones for more other books, right? So give me a thumbs up, give me a comment, so that I can know that this is something that interests you as well. Hope you like this video. Please do share, like, and subscribe. Thank you.